Okay, sir, so coming to India's 102 share-based payments. See, enter whatever ESOPs chapter we did, that was totally based on a guidance note given by ICAI, and the title of the guidance note is Employee Share-Based Payments. There is no standard guidance note, that too only for employee-related share-based payments. We do not have a standard, and you must be knowing guidance notes are not mandatory. Guidance notes are only recommendatory in nature. So we don't have a official standard on this in terms of normal accounting standards. But in Ind AS we officially have IFRS 2, which is converted into Ind AS 102. And Ind AS 102 ka title is share-based payments. It means any kind of share-based payment accounting is there inside this. Okay, now what is the definition of share-based payment? Sir, our entity has entered into a contract with counterparty. Counterparty can be anybody. From that anybody, from that other fellow, we are taking some goods or services. And as consideration, we agreed to issue shares, or we issued to pay cash, and the amount of cash is linked to the value of the equity shares. That means either we committed to issue equity instrument, or we committed to pay cash, and the amount of cash is based on the value of equity. So either you promise to issue share, or you promise to pay cash, which is linked to the value of the share. And when you say equity instrument, it need not be your entity ka own equity instrument. It can be equity instrument of any entity within your group. When you say group, it's not you alone, no, parent plus subsidiaries put together is group. Suppose I am a subsidiary company. I can promise to my employee that you serve me for a period of 3 years. At the end of 3 years, we will give you shares of our parent company. The promise also is covered under this, because entire group is treated as one entity. So even though services or benefits are received by one entity in the group, it is always possible that shares are issued from another entity, because in a group 10 companies are there, sir, parent plus subsidiaries put together. And even though 10 companies are there, only one company is listed, and it is a Cat A company, top category company. So every employee will be motivated only if you promise him the top company ka shares. He might be working for any other company in the group, but for the work what he has done, he will be entitled to shares of that one top listed company in the group. So therefore, group-based share-based payments are also covered under the standard. Next, based on the discussion what we just now did, share-based payments are of three types. One is equity settled. Equity settled ka meaning is ultimate end result is our entity or our group will end up giving equity shares to the counterparty. Cash settled plans, where company or our group will pay cash, and that cash is based on value of shares. Number three, a mix of these two, equity with cash alternative. That means we will give a choice to the employee. If he wants cash, we will pay him cash. If he wants shares, we will give him shares. So these three plans are broadly accounted in the standard. Next. Now, one rough entry I will tell you. Based on that, entire measurement principle is highlighted. Then we will go and see specific cases. Now, you have to pay consideration to anybody because you obtained some benefit from them. Then that benefit, how will you account it? For example, if it is services, you will recognize it as a expense. If you received goods, then you will account it as purchases. If you received an asset, then you will call it as a PPO, intangible asset, IPO, something. So the debit portion is clear. Credit portion, if you promise to pay a share-based payment to this fellow, then you should credit either a SBP reserve, or you should credit a SBP liability. You will credit SBP liability if ultimately you are going to pay cash. The cash settled plans, you will credit SBP liability. Equity settled plans, you will have to create SBP reserve. Broadly, this is the entry. Accounting lo, you will not get anything more than this. This entry only, instead of writing directly, round about we might be writing, but broadly entry is only this. Next question. Sir, the entry should be recorded at what value? The entry should be recorded at what value? In this, listen carefully. First priority is fair value of goods or services obtained. This is first priority. It is not like PP lo exchange PP fair value of assets given up with the first priority, not like that here. whatever you are receiving are fair value first priority here. Okay, but if it is employee related services or any other similar arrangements, fair value of services received is difficult to value. In that case, we will take fair value of share based plan. Sir, in a typical ESOP, you understand there is a grant date, there is a vesting period, there are some vesting conditions, and once that vesting period is over, if all the conditions are fulfilled, then employee will get a right to buy the shares at a predetermined exercise price. This much ESOPs everybody understands now. Now tell me, sir, for giving all that, for fulfilling all that vesting conditions only, first day we are giving him one option, correct? Normally, from your derivatives you must be knowing, if anybody wants an option, they have to buy the option by paying some money, premium you have to pay. But in this case, what is happening? The company is giving option to the employee freely first day. Is it really free? No. Instead of cash, that fellow is supposed to give me services. And which services? Services to an extent where he has to fulfill all the vesting conditions. So you tell me, how will you measure that service? Service ka valuation, how will you do? What is there, sir? For that service, whatever you pay, that only is the value of the service. For example, morning I came here in a cab. I paid 100 rupees to that fellow. It took me from my home to this area, 7-8 kilometers. That's a service what I took. A service I paid him 100 rupees, let's say. So what is the value of the service? Whatever I pay, that only is the value of service, because the real benefit of the service may be more, but I cannot value that. The services case law, usually we take whatever we give as consideration, that only is understood as value of service. You may argue, sir, employee services, employee you are paying salary, no, a salary paid only should be the value of service. Why are you taking this options ka value? Listen, salary you are paying him not for fulfilling vesting conditions. Salary you are paying him for daily coming and going. What are vesting conditions? My profit should increase so much, my number of sales units should be increased, my cost of production should come down, you should not leave the entity in the next 3 years. For putting all these conditions extra, for that you are giving option. So for that, the extra services what the employee has to give to increase your sales target, to reach your sales target, to increase your profit margin, for this employees have to put some extra effort. No, extra effort ka valuation, how will you get? You can't get. Therefore, in employee related cases, you will take fair value of share based payment plan issue. Make clear here, this is the first priority. This is second priority actually. But employee related case law, you will have to take only this. So, let's take an example. On 1st March 2024, we purchased a machinery whose fair value is 13 lakhs. 13 lakhs, 10 lakhs. And we promised to issue 1 lakh shares at 3 months' time. Machinery now only you received, but shares you will issue after 3 months. So forget about the amount, let's focus on plain skeleton entry. Since machinery is obtained and ready for use within our control, I can debit machinery. Did I issue shares? Going to issue shares? Going to issue shares. Therefore, you have to create a SBB reserve. Next question. The amount should be recorded at what value? You have two options, two possibilities. Number one, fair value of machinery acquired, or fair value of shares what you promised to issue. Two are there. In fact, I am giving you that also. Fair value of share is 11 rupees. Or else, let's say, make it a bit more believable. 10,000 shares. Fair value of the share, you take it as 120. Face value is different. Face value is 10 rupees only. Yeah. Which answer? 10 lakhs, 12 lakhs. Any amount you write, entry will tally. You don't get any ideas like I will write top number with 10 lakhs, bottom number with 12 lakhs. No. Entry was a number. So 10 or 12 or first priority always fair value of what you are receiving. What am I receiving? Machinery. Machinery ka fair value reliably measurable only. Take that, finish it off. 10 lakhs. 10 lakhs. Now at 3 months time, I have to issue shares. At that time, fair value of the share is 150. I have to cancel my SBP reserve. SBP reserve already appearing in my book set. 10 lakhs. Cancel that. Out of that, go and issue equity share capital. How many shares? 10,000 shares. Face value 10 rupees only. So that is 1 lakh. Remainder amount, take it to your securities premium balancing. What you should not do is the trap, sir. Don't touch this. Don't touch it. Why, sir? Why means SBP reserve means equity instrument, equity accounted, own equity. And what did we learn in India's 109? Own equity items subsequently should not be remeasured. Subsequently should not be remeasured. The answer will not change even if this was not available to you. In that case, you are forced to take 12 lakhs. Subsequently, when you issue shares, then also you will write 12 lakhs and this number will be 7 lakhs. This is always a trap, sir. Equity, own equity items, first day recording, subsequently there is no fair valuation. Am I clear till here? The India's 109 ka, India's 32 ka application. Own equity cannot be fair value. Next. There are two important terms. This is highly likely for upcoming exams, sir. On this one, question is also there. Grant date ki, measurement date ki link you must understand. What's the meaning of grant date? Everybody knows the term grant date. Grant date means it's the first day when option is given to the employee. True, but official definition is it is a date of contract. It is a date of contract between our entity and the counterparty, and the date on which it is approved by both the parties. So it's important. So it means the date on which entity and other party have agreed and approved the terms and conditions of SBP arrangement. The grant date. Sir, why is it relevant? Why it is relevant is, look at this. Just now we wrote one entry. This is machinery transaction. Machinery transaction. This entry lo, a fair value is there, no? Fair value. On which date did you work out the fair value? Whether 10 lakhs or 120 rupees, both are fair values only. A fair value measurement on which date I should do? That is the question. Standard says, except in employee case, in every other case, you should measure the transaction on the date when goods and services are received. Machinery, when did I receive in this example? On 1st March 2024. So on 1st March 2024 only, I should work out this fair value. On 1st March 2024 only, I should work out this fair value. Whatever 120, 10 lakh rupees we are seeing, no, both are worked out on which date? The date on which machinery is obtained. It is available for our use. The contract to buy machinery, the contract to issue shares might have been entered on 15th February only. That is grant date, the date on which terms are agreed. But machinery is obtained on 1st March. So valuations also should be done on 1st March. But in exception, is it exception? Employee services. In an employee services, measurement date should be grant date and not when services are obtained. That is the exception. Sir, why, sir? Sir, ESOP's case we all understand. Grant date ki me gives a shake hand to employee and put an option in his hand. Services, when will he give me? He'll give me over a period of 3 years. If I go on measuring equity item over a period of 3 years, that amounts to remeasurement of my own equity instrument which is issued on grant date. Is that allowed? Not allowed. That is the reason employee related share based payment ki measurement date will be grant date and not the date on which services are received. Whereas in any other case, whenever goods and services are received, that only must consider for measurement. Clear? So this is important, sir. On this question is there RTP question only, but it is yet to be asked in the exam. For employee and any other similar kind of services, measurement date will be granted. In any other transaction, measurement date is when the entity obtains goods and services. Clear, sir? Now coming to ESOPs. Now, The date when ESOP paper is handed over to the employee, we both agree the date is called as grant date. After the grant date, the company will tell that there are some vesting conditions you have to fulfill. Only if conditions are fulfilled, as an employee, you can exercise this option. The period in which these conditions are to be satisfied, that period is called as vesting period, and the conditions are called as vesting conditions. The vesting conditions, there are two types of conditions will be there. One is service condition, the other one is performance condition. Service condition means you should just continue in our service throughout the next 3 years, 5 years, this kind of thing. Just stay in our company, don't leave. That is service condition. Performance condition means you should not only stay, you should achieve or meet some target. Like you should increase the sales growth rate, profit margin should be increased, cost of production should be decreased. These kind of performance targets you are putting. This is called as performance condition. In performance condition, again two subcategories are there. One is non-market performance condition, one is market performance condition. Increase in sales, increase in net profit, increase in growth rate of earnings, decrease in cost. These are all examples of non-market performance condition. Market condition means only one. What is that? If you put a market price of the share target, suppose options exercise price is 100 rupees. You tell the employee that, employee, you should stay in my office for 3 years. Okay, sir. You should increase the sales by 200%. Okay, sir. Net profit growth rate should be 20% per annum. That is also okay, sir. So for everything he is telling okay. Lastly, you tell him that share price by the end of 3rd year should cross 500. So apart from all the non-market conditions, you are also putting a market price target also. A market price target is called as market condition. Rest all are non-market condition, including service condition. Right. If all the vesting conditions are fulfilled by the employee, then we'll say that the options are vested. Options are vested ka meaning is employee is eligible to exercise the option. Sir, when can he exercise? Once the options are vested, the company usually gives some time period to employee so that he can arrange the money, pay the money to the company and take the shares. So that period is called as exercise period. Yes, sir. So our entire, see, whenever we talk about ESOPs, no, in your mind, a timeline should be properly visible. This 0 time is called as the grant date. The period over which this fellow has to give you services, this is called as vesting period. The conditions what he has to fulfill during this period is called as vesting conditions. And once vesting period is over, if conditions are satisfied, we say that options are vested. And during this period, any time employee can exercise the option. Exercising the option meaning is, this is company, this is employee. Employee will pay exercise price money to the company. Company will issue shares to. This is called as exercise of. This will happen if the employee chooses to exercise. Suppose there is an employee whose options are vested, exercise period is also getting over, he did not exercise the option. On the last day, HR manager will call, sir, tomorrow is the last day, you did not exercise your options yet. Fellow shows attitude. I don't want to exercise. This is called as vested options lapsed. Even though options are vested, he would not want to buy shares of that company. Possible. There are some employees who did not fulfill vesting condition only. Some fellow ran away in first year only from the company, or some other vesting conditions are not fulfilled. In that case, here only some options are lapsed. This we call it as unvested options lapsed. This attitude fellow case is vested options lapsed. That is also possible. This is the overall story, sir. Okay, this is the plan. Now the question is accounting of this. Accounting part, what you are supposed to do is, in a very simple terms, on the grant date, work out the fair value of the option. As just now discussed, in every other case, the entry ka measurement, entry is there, this first entry whatever, the entry ka measurement is done on the date when goods and services are received by the entity. Only exception is ESOP's case. ESOP's case law, you should take fair value on the grant date. For fair value of option means in your AFM, binomial model, Black-Scholes model, put call parity. So many methods are there. Our methods lo whatever number comes, our number you have to bring. Sir, you must understand, if employee has a right to buy share, do you understand it's a call option? Employee is having a right to buy a share means the call option. A call option ka valuation formula apply and bring the number. Let us say a number is 120 rupees. So I have given an option worth 120 to the employee and he is not paying me anything in cash right now, but in return he provides me services in kind over the next 3 years. Since the company is going to enjoy benefit in the form of services in the next 3 years, the 120 rupees value should be booked as an expenditure in P&L account over the vesting period of 3 years. So option expense per annum is equal to a very simple 10 case. I will develop slowly into bigger one. 40 rupees per annum. So every year you have to book an expense of 40, 40, 40. Sir, what entry will I write? Your entry will be this. Sir, what is the entry for salary paid? Salary to bank. What is the entry for salary payable? Salary to salary payable. Same entry, sir. Salary, I am glorifying it as employee compensation. Salary payable, since it is not a liability, but we promise to issue fixed number of equity shares, we are crediting this to an equity account called as SBP reserve. 40, 40 in first year. In second year also 40, 40. In third year also 40, 40. Like how salary jumps off to PRL, this also will jump off into PRL. SBP reserve keeps on getting accumulated in the balance sheet. Now when I show you balance sheet at the end of year 3, on the liability side under the equity heading, you will have SBP reserve created overall for an amount of 120 rupees. SBP reserve basically represents the obligation of the entity towards the employee for issuing equity shares. This is referred, even though its name is SBP reserve, it is in textbooks and all, it is called as, if there is an obligation to pay cash, the cash obligation, financial liability. It is not an obligation to pay cash, it's an obligation, but to issue equity shares. Therefore, we call it as equity obligation SBP reserve. Do you also observe that SBP reserve account by the end of vesting period, 120 rupees, is also representing the value of the option on the grant date? Whatever 120 you valued at 0 time, that only is accounted over a period of 3 years, which is ultimately appearing in your balance sheet, correct? Now, an employee chooses to exercise the option. When employee chooses to exercise the option, bank account debit with the exercise price whatever he gives me. Imagine exercise price is giving me 80 rupees. So, I have to give him equity shares. So, equity share capital face value 10 rupees and I will have to credit securities premium. Now, since you discharged the obligation by issuing your equity shares, whatever SBP reserve you created for this fellow, SBP obligation has to be eliminated now. So entry will be SBP reserve also has to be cancelled. An amount of 120. 80 plus 120, 200. Out of the 200, 10 rupees is face value. Remove that. Remaining 190 is securities premium. So securities premium number, you should take it as a balancing figure. You should not go to the market now and see what is the correct market price. Market price is 500 rupees, face value is 10 rupees, 490 securities. No sir, you should not do that. Sir, why should I not do that? Equity shares are coming newly, but equity obligation newer, it was already there. Own equity should not be remeasured again. Own equity should not be fair valued subsequently. That's the reason you should not go to the market and fetch correct market price today and all. Don't do that. Securities premium to take a balancing figure. Now, how to split this entry? The entry splitting also is equally important because ledger accounts, when they ask, you will be in trouble. So, how to split this entry is, when question asks you journal entries, this will do. If the question asks you ledger accounts, your thought process should be like this. SBP reserve, how much money is there? 120. Now employee pays you how much money? 80. So what you will do is bank account 80, also you go and credit it to SBP reserve only. 120 that fellow gave me in the form of services. 80 he gave me in the form of cash. Total he gave me 200. 200 is sitting in which account now? SBP reserve. Kill SBP reserve. And credit this to equity share capital and securities. This is how you will do it. You understand, sir? Employee is buying shares by paying a cash consideration of 80, kind consideration of 120. Kind consideration already sitting in SBP reserve, cash also transfer there only, total issue price will come, split it into face value and securities premium. Like this you have to split. If you know this entry only, ledger account you can post correctly. The material loan, sir, not right entry. Are you understanding? Now, let's go little deeper. Imagine I am having 1000 employees. Each employee I am giving one option. Rest of the data same. Fair value of option 120. Exercise price is 80. Vesting period is 3 years. Now, what is the option expense? On a very basic level, 1000 employees are there, one option per employee, 120 rupees is the worth of the option into 1/3 because over a period of 3 years. So every year I should book an expenditure of 40,000 per annum. This is very simpleton example, simpleton formula. This formula we can code it into a little bigger way so that we can accommodate all kind of adjustments, employees leaving, options changing, all these kinds, vesting period changing and all. So to accommodate that, we can create a bigger formula also. Bigger formula looks like this. Option expense per annum is equal to number of employees into number of options per employee to fair value of option on which date granted. In this there is no compromise, sir. Into vesting period completed till date divided by total vesting period minus option expense recognized in earlier periods or previous year. A big formula is what is best to apply. You might, some of you might have learned this in the form of a table. Table is also okay. Formula is also okay. Formula is easy to observe the entire picture at once. Table is also okay. Answers will be same any which way. Okay. Now, when I am in year 1, imagine no employees changes there. 1000 employees. One employee. So one option per employee into 120 per option into 1/3 minus 0. Answer is 40,000. So with this I will go and write an entry. EC, employee compensation account debit to SBP reserve 40,000, 40,000. Year 2. When I am in year 2, I am making a small change. 200 employees ran away. So I don't have 1000 employees anymore, I am having only 800 employees. So in second year when I do this, 800 employees into 1 into 120, vesting period finished till date is 2, overall vesting period is 3 years, minus already booked in the previous year 40. So answer should be 24. Right, like this. 64,000 minus 40,000. Answer is 24,000. What is this 64,000 representing? After considering the some employees who left, by the end of second year, you should have a closing SBP reserve of 64,000. Opening already I have 40,000. So you have to further create now 24,000. That is the meaning of that. Now, when I am in year 3, still assume nothing else changed. So 800 employees into 1 into 120 into 3 by 3 minus 40,000 first year I booked, 24,000 second year I booked. Overall answer is 32. The 32,000 expense you will book in the third year. It is completely 96,000. Am I clear till here? Now listen. Ultimately, how many options vested? 800. So 800 employees into 1, 800 options. What's the worth of each option? 120. 800 into 120, 96,000. 96,000, if I amortize it over a period of 3 years, each year cost is how much? 32, 32, 32. But when I was in first year, I did not know that 800 employees will be there. So I booked how much expenditure? 40 first year. So first year, how much extra expenditure did you book? 8,000. Whatever 8,000 you booked extra in the first year, that automatically got adjusted in the second year. And now that it got adjusted and third year there is no further change, uniform 32,000 became expenditure of the third year. This is a cumulative adjustment approach. This, even though standardly wording is not there, this is called as retroactive approach, or it is called as cumulative catch-up approach. The wordings are given in standard 115. Revenue standardly wordings are used, but the wordings ka meaning is this only. Had I known this from the very beginning, up to now how much I should have done minus what I have done already, a difference accounting whatever is there, that is called as retroactive approach, that is called as cumulative catch-up approach. Clear sir? E formula whatever we did, e example whatever I have discussed, totally correct except for one small point, that is employees. Okay, numbers I wanted to have you clarity. Let's discuss. Employees alone I will talk now. Sir, you are having 1000 employees. Vesting period is 3 years. In the first year, already 50 employees ran away. So you are having 950 employees. I have to recognize option expense in year 1. You know the big formula whatever we just now discussed. Number of employees into options per employee into fair value of the option into 1 divided by 3 minus 0. Some number will come. This is the amount with which you will go and write entry at the end of first year. By the end of first year, how many employees are sitting? 950. 950 you should not write here. That is wrong. What you should do is, you stand here, estimate by the end of vesting period, how many employees will be there in your company. Today 950 are there. Today only you have to write entry. But number of employees is not today's employees. How many employees are likely to be there by the end of vesting period? Suppose in your estimate you have observed that in second year another 70 will leave. In third year another 80 will leave. So another 150 will leave. So you are foreseeing only 800 employees. Where are you standing now? First year ending, and you are seeing that by the end of third year 800 employees will be there. So you will compute only for 800. But you understand the number of employees, you should be very, very careful. Number of employees is not the number of employees who are sitting in your office on year 1 ending. Similarly, when we come to year 2, I estimated 70 will leave. Actually 90 left. So 950 minus 90, actually I am now having 860 employees. So when I am working out option expense of year 2, I should not do 860 employees and all. I should again foresee by the end of third year how many are likely to be there. If I believe that out of 860 another 90 will leave, so 770 employees only I am able to foresee. So in the second year when you are there, you will compute only for 770 into 2 by 3 minus E number You understand, sir? Number of employees should always be estimated employees at the end of vesting date from your balance sheet. When you come to third year, you should not open your binocular now. Why? At the vesting period ending, you will obviously know the actual number of employees. So last year you will take the actual. So number of employees should always be the number which is estimated at the end of vesting, or likely to be there towards the end. Clear now? All these points and questions how they will present all this. Everything, formula is given here. Number of employees, questions how to read, a rate of exit, and how to understand all that I have given here. Before you solve the problem, once go through this and touch any sum, it will work. 100% it will work. Just need to be a little patient. Entries already discussed, sir. Now, what is pending? Market condition is pending. Okay, let me discuss once again and then we'll take up a small case also. Sir, I wrote entries like this. Employee compensation. 2. SBP reserve. First year, second year, third year. 40, 40. 40, 40. 40, 40. Easy case usage. Only one employee, 120 rupees fair value, amortized over a period of 3 years. Like this. By the end of third year, I will have SBP reserve of 120. If employee exercises the option, we know what accounting you have to do. In these different cases, basic level story, if employee lapses, he said, I don't want. Okay, what will you do? You will wait till the end of exercise period, and the option, if it is still not exercised, then whatever SBP reserve you created, cancel it, transfer it to retained earnings. You should not take to P&L account and all, that is wrong. Why should I not take to P&L account, sir? That poor fellow gave me services. Correct. He gave you services. We enjoyed the services, but he says that he does not want anything from us. So in a way, this is a kind of a gain for us. Why should I not take it to PRL? It's a gain with whom? With a holder of equity instrument, an employee, but in his hand one paper is there. A paper is a ESOP paper. ESOP is the equity instrument. Because of that paper, that fellow's character is equity instrument holder. With that fellow, any gain or loss comes, that cannot go into PRL. Will merge it off into retained. You understand, sir? The last one. Another case. Fair value of option 120. Option expense is 40 per annum. Data same, story different. When I am in year 1, I wrote this entry. Employee compensation account debit to SBP reserve, then amount of 40, 40. When I am in year 2, also I wrote the same entry. Employee compensation to SBP reserve, 40, 40. And where is this compensation going? It is transferred to P&L account. Expense book JSM, and correspondingly reserve we are creating. Now you are in year 3. Watch carefully. Year 3, you understood that options are not vested. Sir, why option is not vested? You tell me why option is not vested? Since vesting condition is not. Then why did you book expenditure in first year and second year? At that time I thought it will be satisfied. I booked. Third year, clarity came. Vesting condition failed. Vesting condition failed, no. When vesting condition failed, will you still book expense? You should not book any expenditure in the third year. Not only you should not book any expenditure in the third year, whatever expenditure you already recognized in year 1 and year 2, that also you have to reverse off. Clear? Now, what is the entry we will write now is SBP reserve account debit to employee compensation account. Will go ultimately to PRL. I want you to observe the difference very clearly. When option is vested, employee chose not to exercise. SBP reserve, where did it go? Retained earnings it went. Asal option A did not get vested. Already created SBP reserve cannot go to retained earnings. It has to go into pure. It has to go into pure and it cannot book it into retained earnings. Sir, what is the difference? Difference is simple. Throughout vesting period, option expense should be recognized only in P&L account, even if option expense is negative like this. Apply formula, simple. Common sense, you answered. Apply formula, you will get clarity. ఈ ఫార్ములాలో సార్ ఈ బిగ్ బాక్స్ వాట్ ఎవర్ ఇస్ దేర్ మైనస్ expenditure already recognized in the earlier years. Do you observe that this is the closing balance of SBP reserve and this is the opening balance of SBP? Do you understand this much? Right? By the end of third year, I am standing and I know that options are not vested. When options say not vested, do I have any equity obligation towards my employee? Yeah? This should be there. Whereas my opening balance is there, which is, if you check the answer now, it is minus 8. Answer positive, so we are writing one entry. No, answer is negative. What will you do? Write reverse it. Go to pure. Am I clear till here? So, what am I trying to say is, after the vesting period, options got vested, employee choose not to exercise. SBP reserve, throw it into retained earnings. As an option A did not get vested, take it to P&L. Because during the vesting period, you cannot go into retained earnings. You can go to retained earnings when only vesting period should be complete. The vesting condition fulfill aitene retained earnings story will come. Otherwise, it will go to P&L account. Till here, if clarity is there, I will discuss next point with you, which will be confusing. If you have any doubt on this is the time. In this ideally, you should not have any doubt. This plain case. Option vested, he says, I don't want the option, I don't want to exercise, fine, we will take it into retained earnings. Option A did not get vested, no retained earnings for you, directly you have to go into P&L account. Whatever you created till now, P&L you have to reverse. Sir, why should I reverse to P&L account? There is another reason also I am telling you. First year I thought that vesting conditions will be fulfilled, benefit is coming, and anticipation I booked expenditure. Third year I realized that benefit A did not come. The unnecessarily booked expenditure, change in accounting estimate, reverse it off. Another version of understanding this. Now, I'll tell you something which will sound like a kind of exception to the point what we just found. But lastly again, we'll sum up and we'll see to that you are not overall confused. This is the story of market condition. Market condition lo company what it does is it tells the employee that options you can exercise only when share price reaches a particular target price. Otherwise, you cannot exercise the option. Now, let us take one easy example. 0, 1, 2, 3. I told the employee that option will get vested to you only if market price of the share exceeds 400 rupees at the end of third year. If it does not cross 400, options are not vested. Even though you stay in the company, even though you fulfill remaining conditions, still options will not be vested to you. Am I clear till here? This is the question. Now, data. On this date, I gave you fair value of the option. Let us say got 90. So, first year 30 rupees expenditure I booked. Second year 30 rupees expenditure I booked. Entries you know already. What is the entry? EC2 SBP reserve. Here also EC2 SBP reserve. Now throughout third year, employee stayed in the office. Third year last day also he is sitting in the office only. Should I book expenditure? I should not book. Should I book expenditure or I should not book expenditure? What do you feel? What is there, sir? It depends on whether options are vested or not. Options are vested or not depends on what now here? Market condition. What is the market condition given to you? 400 rupees it should cross. Now two possibilities exist. What is possibility 1? Market price actually crossed 400. The other one is market price is less than or equal to 400. In first case low, definitely you know that options vest. Second case low, options do not You should not use the word lapse and all. Options do not vest. Tell me entries in first case. Only one entry I have to tell. First year booked expenditure, second year booked expenditure, third year ending la, I am telling you options vested. Tell me entry. Very easy. Same entry. Same entry. EC2 30. When sir, when market condition is satisfied. In this, no fool will make mistake. Second case, you should be careful. Market condition failed. When market condition failed, options do not vest. Correct? When options do not vest, ideally what I should do normally? I should not book any expenditure in the third year. Moreover, whatever is already recognized in year 1 and year 2 also, I should reverse that into P&L account. Correct? That is what we did in the previous example also here. Correct? But if it is market condition, Noma, you should not do like that. Not do like that. Now what should I do? Book expense. Book expense, even though you know that options did not vest, market condition failed, still you will book expenditure. Sir, but options are not vested. Why are you creating SBP reserve? You will know. So what is your SBP reserve total balance now? First year 30, second year 30, third year just now you created 30. So total it is 90. But options are vested or lapsed? Lapsed. So what you will do is entire SBP reserve you will transfer it to retained earnings. When options are vested, anyway you will book expenditure. Where is big a point in that? When options are not vested in the last year, knowingly you will still book a expenditure, create SBP reserve, then cancel SBP reserve into retained earnings. You will not do what we did here. What did we do there? We reversed expenditure of first year, second year into P&L account of third year. That you should not do when market condition is failing. This is the rule. You have to anyway remember it. Remember it. Logic I am telling you, if you understand it's fine. Otherwise also it's fantastic. You by heart this and go is important. Logic is very simple, ma. If fair value of option and whatever you are seeing here, no. How did you get this number? You only wrote, no. I wrote, but in real life, how will they get this number? No. Fair value of option, not share, no. Option valuation you have to do. There are methods, no. Binomial method, Black-Scholes model, so many stupid methods are there. Methods what you learn in AFM are models you apply and you have to bring this number basically. Okay. Now, quickly I will go to AFM and come back quickly. In AFM, there is something called as binomial model. Any model this can be discussed, but here it is easy for me to explain. There is something called as binomial model. Binomial model believes that spot price of the share can take two prices, one high price and one low price. Remember? And if you see any question of binomial model, the high price, low price, one price option will get excised, another price option will get lapsed. Do you remember that? Since we are talking about ESOPs, ESOPs is nothing but a call option. Here it will be excised, here it will be lapsed. Now, suppose exercise price is 100. Okay? High price is let us say 150. Low price is 80. So, assuming that option will get excised on the top side, which is 50 benefit I will get, whereas here I will get nil. If I ask you value of the option, what will you do? You will then bring probabilities into picture. Risk neutral probabilities and all are there. Now you will bring that. You will say 50 here, 60% here, 40% something you got. Then you will work out a expected value of the option. 50 into 0.6 plus 0 into 0.4, which is 30. E30 rupees, you will again discount it to today. Correct? After discounting it, let us say you got 26. E26 is called as value of call option. A 90 and whatever you saw now, a 90 is worked out like this. Correct? Now, tell me, in working out the value of option, did you consider the possibility of market price not hitting the target? Is there a possibility of option getting lapsed? Is there a possibility of option getting lapsed? That means because you considered this also, this eventuality also you considered, this became 30. Had you ignored this completely, Had you ignored a low price portion completely, your payoff would not have been 50 or 30, it would have been 50. And 50 when a discount, I won't get 26, no. I will get 48 or 47, something like that. That means option valuation models, any model, by default considers an event called as market price will reach a level where a option will be lapsed, and because of that lapse situation, option value is already reduced. That means, see, there is a probability that option will get exercised. There is a probability that option will get lapsed. Both I considered. Because of that, the number is an average number. This is not a pure number which only thinks about exercise of option. Lapse of option on an event also is already factored into option valuation. Likewise, in 90, whatever you are seeing, no, this is a number which is derived after assuming that option will not be exercised ultimately. The point is already factored in that. Since it is already factored, a 90 and a number is already on a lower side. Had you not factored this event, a number won't be 50, no, a number won't be 30, a number would have been 50, and the discounted value should be something around 45. But instead of booking expenditure at the rate of 45, I am booking at the rate of 26 because already I am booking a lower expenditure. Since anyway the event of option not getting exercised is already factored into this, suddenly if this happens and options do not vest, you should not say, we thought that options will vest but ultimately options did not vest. This is not a new information for you. This is an event which is already considered where in valuation of option. The option valuation by the model itself, it considers the event of option not getting vested also. Since that is already packaged into option valuation, suddenly you should not change your accounting treatment when options really do not vest because of failure of market condition. You see, sir, if you remember, value of option depends on spot price of the share, exercise price, risk-free rate, time, exercise period. If you take Black-Scholes model and all, standard deviation. These are the factors which influence what? Option. So spot price law fluctuation is already considered. The chance of option getting lapsed is already factored in this call option valuation. So suddenly if market price did not meet a particular limit and options did not vest because of failure of market condition, this is a surprise news to us. No, it is not surprise. It is already packaged where a 90 rupees is already considered. A 30 is already lower number. Shut up and book the expenditure. Since it is already packaged. Adil, look at this case. Year 3 lo, sir, option not vested since employee resigned. Employee ran away, sir, third year la. Options will get vested. No. Is market condition, non-market condition? Non-market. Tell me, sir, employee leaving the entity before 3 years, anedi, can I consider that in option valuation? Option valuation is only based on 5 events. Spot price, strike price, risk-free rate, option maturity period, and standard deviation. Employee may leave can I consider that? Employee will not increase the net profit by such particular limit. Can I consider that in option valuation? Since I cannot consider that in option valuation, accounting adjustment is required. But market price not getting, option not getting vested because of market price fluctuation is an event which is already factored in this. So ultimately, if options do not vest because market condition is failed, you should not change your accounting. Accounting continues. Same thing. There are 2 questions in study mat based on this. In both the questions, question neatly will explain. Third year, whether market condition is satisfied or not satisfied, the question even don't even tell you. It won't even tell you as market condition satisfied or not satisfied. Why is it not telling you? It doesn't matter. Satisfied also same entry. Not satisfied also same entry. If it is not satisfied, one extra entry of rate. ISB price, you have to put it in your text. Sir, one more doubt. Sir, why to transfer to retained earnings? Why can't I credit to P&L account? If you credit to P&L account, what will happen is, you wrote the first entry. Here you debited P&L with how much? 30. If you credit P&L with 90, effectively you are crediting P&L with how much? 60. 60 is nothing but first 2 years expenditure. That only you are not supposed to do, and we are telling you now. Last 2 years expenditure should not be reversed to P&L account. That when you can do, other cases you can do when a service condition or a non-market condition, if that fails and because of that options do not get vested, accumulated SBP reserve till now entirely will come to P&L account. But if it is market condition, it will not come to P&L account. It has to be adjusted into the retained earnings there. The entire story. So this is about basic accounting of ESOP's case. In some cases it will be like this also. Like, I tell you, overall span 10 years, I tell the employee excess price is 100 rupees per share under option. When will the option get vested? This fellow says, whenever market price crosses 400, options will get vested. In the next 10 years. I am not saying market price should cross 400 by the end of 10th year, not like that. Whenever it crosses 400, options will get vested. What is the difference between this one and previous example is, in the previous example, the vesting period is defined. Here vesting period is not defined. Overall 10 years period, any time options can get vested. It is like that. So, in this case, how will we do? Here's what you will do is, company has to estimate a vesting period. Without estimating vesting period, how will you know exercise date? How will you know the valuation of option? First of all, the company definitely has to make a vesting period estimate. Imagine they estimated it as 4 years. So, 4 years is an estimated vesting period. Based on that only, they will identify the fair value of the, let us say fair value of the option is 160. Therefore, option expense will be how much? 160 to 1 by 4, which is equal to 40 per annum. So what you will do is, first year, second year, third year, fourth year. Every year you have to go and book an expenditure of 40 for a period of 4 years. By the end of 4 years, you would have already created an SBP reserve of 160 rupees in your balance sheet. It does not matter whether market condition is satisfied or not. You should never ever change this vesting. You estimate only once you have to do when granted it. The vesting period estimate changes can come, but accountingly you are not supposed to update this. That means 4 years, and when did you think? First day you thought. First year ending also same feeling. Second year ending my feeling changed. No sir, market price cannot cross 400 by the end of 4th year. It will cross definitely in 7th year sir. Denominator I will take 7 now. No, not allowed. Vesting period changes because of market conditions are not allowed. That means when I am in year 1, my thought process will be like this. 160 is the total value of the option. Till now 1 year is over. Overall vesting period is 4. Expenditure recognized till previous year is 0. Answer is 40. When I am in year 2, my feeling is market condition will get satisfied at the end of 7th year. So this fellow wants to write like this. Not allowed. Vesting period revisions are not allowed because of market condition. Any other condition, no problem. Market condition cannot allow. So then what should you take? What will you take? 4 only you will take. Previous samla problem will not come because vesting period is defined. The vesting period undefined. In case law, company will estimate whatever they have estimated. You have to stick to that. Revision not permitted. Clear? Exception. In one case permitted. Which case? Come here. Year 3. Market price actually exceeded 400. I estimated 4 years, but target condition got satisfied in the 3rd year itself. So what you will do now? 160 into 3 by. Normally you would have written 4. Don't write 4, right? 3 only. Minus 40 plus 40 last 2 years. Your answer now will be, you know what is 80? Third year expenditure plus fourth year expenditure at once is getting booked in the third year itself. Preponement, or in the standard they refer it as acceleration of option expense. Acceleration is speeding up the option expense. Why should I speed up? Ready, options got vested. On one side options are already vested, employees are exercising. Fourth year I will be booking option expense. I know. In this case you can change. Clear sir? Every point important. Questions are there sir, questions are there. We are not doing anything for time pass. This is all given here. Read this one sir. Possibility 1. Possibility 2 is easy one. We already covered. Possibility 1 read. Market condition without any time limit. Brackets. Options will vest whenever share price crosses some amount. On the grant date, the company will estimate a vesting period by which market condition is expected to be satisfied. Optional expense has to be recognized over this estimated vesting period. Any further estimates regarding the vesting period shall be ignored. Question la pakka they will tempt you sir by giving so much of stupid data. Adi any other condition you can change. Market condition you cannot change. At the end of vesting period, expense has to be recognized even if market condition is not satisfied. A fourth year you have to book that 40 rupees also. Market condition really satisfied or not irrelevant for you. However, if market condition is actually satisfied before the estimated vesting period, then there will be a preponement of option expense. This is called as acceleration of options. So preponement travel in 10 years, you definitely have to change the denominator. First year 4 you took, second year 4 you took, third year 3 you have to take. The moment you take 3 in the denominator, third year, fourth year expenditure at once will get booked off in the third year itself. This is called as preponement. E question is there in study material. This is the background for that. Previous sum whatever we discussed are the possibility to the relatively easy only. So till here are you all clear? Simples are before you solve sums, once read this properly, write everything, which case where things are getting reversed, and then attack the problems. Very, very simple. The basics you have to set up correctly. Okay, last 2 points are in ESOPs. One is modification of ESOP. By default, what is the meaning of the term modification? Change in terms and conditions is called as modification. The standard will ask you, identify whether a modification is favorable to the employee or unfavorable to the employee. What is favorable modification or unfavorable modification? Unfavorable modification means you are changing the plan in such a way that employee is not happy. Example, I initially told that vesting period is 3 years. That fellow served 2 years already. What is the remaining vesting period now? 1. I told no. Remaining vesting period is another 3 years. I changed off. Will employee be happy here? Similarly, I initially told that excise price is 100. Now I tell that excise price is 500 rupees. Will he be happy? I initially told that each employee will give 1000 options, but now I reduced it to 600 options only. These are all modifications that are unfavorable to the employee. Standard says when as a company you do any modification which is unfavorable to the employee, you have a right, you do, but accounting purpose it is to be ignored. Ignore such modification. Sir, modification happened now, how can I ignore? Ignore it and do accounting as if there was never any modification. Sir, why sir? Our standard is pro-employee, sir. Our India's 102 is not Communist Party, no. So why are they talking like if it is unfavorable to the employee, you should ignore it? What is the reason? Reason is simple math, sir. Market lo share price 300. I gave to this boy an option whose excise price is 100. He is very happy. 300 cash share. Sir gave to me only at 100 rupees excise price. He is happy. To her also I gave an option. Same share, exercise price is 150. He is also happy, but she is angry on me. Why? Because I am charging extra excise price. The moment I increase the excise price, the option ka value will fall down. When option ka value falls down, the expense in P&L account also reduces. But for example, the fair value of the option given to this boy is higher. So higher expenditure will come over a period of 3 years. Compared to this first option, his second option ka value is lower. Therefore, lower expenditure will come in P&L account. Now imagine, First I gave an option whose excess price is 100. Fair value of option is some amount, which I started booking first year, second year. Third year I tell him that no, excess price is higher. The moment excess price is higher, option value will be lower. My expenditure in P&L account also will be lower. If P&L expenditure is lower, what will happen to your profit? Profit will increase. I initially told you that vesting period is 3 years. So what will happen? Entire option value should be booked as expense over a period of 3 years. Later on, second year I changed it to 5 years. The moment I accept it and start doing accounting over a period of 5 years, what will happen to my expenditure? It will decrease. So unfavorable modifications towards the employee indirectly means favorable to the employer. That will have a positive impact on their P&L account, which our standard does not want to have. So it is asking you to ignore it. Clear, sir? Other case, modifications which are favorable to the employee, like company may decrease the exercise price. Sir, why company should decrease the exercise price? Sir, I gave you options, but subsequently our company has not been doing well. Share price has fallen down. When share price in the market falls down, employees' love on the options will come down. Anyway, share value is falling down. Of course, exercise price is still lower, but the charm it had at the time of grant, it is lost now because share price in the market is falling down. So if employee is no more interested in the options, then he will not continue with our company. To make him happy, I cannot increase the market price, no. So what companies do is they will reduce the exercise. If you reduce the exercise price, what will happen? Option ka value will again increase. Similarly, I can increase the number of options. I initially offered you 1000 options. Now I am offering you, no, not 1000, 1500 options. Employee is happy. So if he is sad because the company's share is not performing well, I can make him happy by reducing the exercise price, increasing the number of options and all. In this case, it is favorable to the employee, it is a cost to the company, unfavorable to the company. For this you have to do accounting. So how to do accounting? Understand the incremental benefit you are giving to the employee and book it as option expense over the remaining vesting period. What is the incremental benefit? Suppose I reduced the exercise price. Let us say our vesting period is 1, 2, 3, 4. Okay. We are standing here, sir, somewhere in the third year. First year, second year, option expense booked 40, 40. Third year also I will book 40, fourth year also I will book 40. But during this day, my employee is sad. Why he is sad is market share price fallen down. Therefore, fair value of the option became 92. He is sad. What I did, our company reduced the exercise price. If company reduced the exercise price, the option paper whatever he is holding, its value became 150. Happy? So because of change in exercise price, reduction in exercise price, option value went up by how much? 90 rupees ka option now became 150. So incremental benefit to employee is equal to 150 minus 9 is equal to how much now? What you are supposed to do is this 60 you have to book it as expense over remaining vesting period. Prospectively you should do. How many years vesting period? 4. How many years are over already? 2. What is the remaining? Another 2. Of 2 years. So each year 30, 30 you do. That's all you have to do. So how did you get that 60? That is important. How did you get that 60? Fair value of the option after repricing minus fair value of the option before repricing. A gap is the extra benefit what the company gave to the employee. Clear? Now I have a small question, try to answer that. In modification, I am telling you that it happened here. During third year it happened. Will your answer change if I tell you that a modification happened here? In the example what I discussed, I assume that modification happening in the third year. Will your answer change if I tell you that this modification happened at the end of second year? Why doubt will even come is, since modification is happening at the end of second year accounts are also open now. Will you book 60 rupees over a period of 3 years? No, only 2 years. Still book it over a period of 2 years only. Just because your accounts are open by the end of second year, don't touch second year ka P&L account with this modification. What is the meaning of remaining? Remaining does not mean what is over, no sir. Remaining means remaining on prospective. Whether you are standing at the end of second year or you are standing at the beginning of third year, answer no change should not come. Prospective effect means only futuristic impacts, not for concluded period. It is very important. There are some questions where modification happened at the end of second year. There are some questions where modification happened at the beginning of third year. Both cases, the answer will be same only. Okay? Now tell me, in third year, fourth year, how much will be your expenditure? Your basic is how much? 40-40. That anyway will be there. Apart from this 40-40, is 60 divided by 2 years will be 30. Another 30 here, another 30. Do you understand what I am trying to say? The basic option expense is the incremental option expense. Like that you have to do. This is modification. Finally, last model in ESOPs is cancellation. Very easy, and it hasn't been tested for quite some time. So important. Fair value of option 160. First year I booked 40 expense. Second year I booked 40 expense. Third year, fourth year also I will book, but I did not book it yet. Meanwhile, what happened is here ESOPs are cancelled. The company killed the ESOPs. You tell me, sir. So ultimately, options are existing or not existing? Not existing. So what should I do? What is common sense telling? First year 40 created, second year 40 created, total SBP reserve is 80. But options are gone now. What should I do? Ideally, the SBP reserve should be cancelled. 80. Credit where? Okay, now, so sir, we should not feel bad that our answer is wrong. The original thought is natural thought for everybody. Okay, only when you do wrong, then you will understand what is the reason why this is wrong. You don't try to be wantedly somehow artificially correct. If it is wrong, let it be wrong. Happily make mistakes. Not in exam. Now you can do. Exam will not make, sir, if you make here. If you don't make here, exam yes, sir. You are freely open to thinking, no, mistakes will happen here, there it will be correct. Otherwise, there you will start thinking freely, randomly. That too, in examination pressure, no sir, mind works very sharply at that time. You start questioning everything. 2 plus 2 will do on calculator. So, in that, when you start questioning everything, different ideas will come. A questioning and the pudiyas, there it will be peace. Anyway, coming back. Standard says, when ESOPs are cancelled, point number 1, do preponement of option expense. What is the meaning of preponement? The 40 which you should have booked here, first book it right now. See how different it is. We told that we should reverse it. That fellow says next 2 years also first book. So entry will be employee compensation to SBP reserve 80. Sir, modification you just saw no favorable, unfavorable to the employee. What did the standard say? Ignore. So unfavorable to the employee means that is favorable to the company only. That they are asking you to ignore. After knowing that, why did you even think like this? If you do this, what will happen? P&L are you not crediting a huge amount? And cancellation is whose wish? Employee's wish. Huh? No, employer hands don't. If I want any time to increase my profit, I will cancel. Won't I manipulate profit if I allow you to write that entry? This is standard logic. Everything has a logic. First acceleration, sir. Preponement. Okay. Now talk. Options are existing or not existing? Not existing. SBP reserve is not required, no? Kill it. At least now tell correct answer. Where? Good. Now we are in line. Sir, I cannot allow you to take this to P&L account. If I allow you to take this to P&L account, you will cancel every ESOP and make profits whenever your company is not doing well. Cancellation of ESOPs, employee will not decide. No sir, employer will decide. Whenever he wants, he will decide and he will start enjoying. You think when I say ESOPs are given, our company lo 5,000 employees are there, small worker, no sir, anta movies lo they will show. Real life ESOPs are given to whom? Top management. Most of them are in the board. They will manipulate, sir. That's the reason it's not allowed. Okay, now. In his hand, option paper is there. Company says, don't throw that paper, use it as tissue paper. You cancelled it. The fellow is crying. Will he stay in the company? Will he stay in the company, sir? If you, after working for 2 years, if you snatch the paper from his hand, will he keep quiet? He is crying loudly. I'll resign. All company secrets I know. Tomorrow only I'm joining a competitor company. He is not watchman, sir, a top management. He knows every strategy, he knows suppliers, he knows customers. Sir, if you have to go into the top tier of the company, you should be capable of getting revenue to the company. So some customers, some companies are in your hands. If company plays with you, will you keep quiet? He will float another company. So if you snatch paper like that, he will not keep quiet. Every tier is very costly there. So the company tells him, Babu, don't cry, we will pay you cash. Cash compensation is given to him to make him stop crying. He is still not stopping. Why is he not stopping? Is he want to extract more money from you. Fair value of the option on the day where you tore the option, no, the fair value of the option was 300 rupees. Let us see how much cash company pays. What do you feel, sir? How much company should pay? If you are that employee, the hands on paper is there. A paper worth 300 rupees. How 300 are 160 only, no? Array, a 160 is on the grant date. You are now standing in third year. Market value will be different, no? Accountingly you will not remeasure because of the own equity. But in reality, value will change. A paper worth 300. You tore it off into pieces. That fellow is crying. No, don't cry. I'll pay you cash. Tell me, sir, how much cash will he expect? At least 300. You may pay 300. You may pay more than 300. You may pay less also. But he will expect 300 for sure. What our standard says is, when you pay cash, you should write entry like this. To bank, debit retained earnings to the extent of fair value of option on cancellation date. In case you pay anything extra, that will be debited to so if you pay exact 300 rupees, total retained earnings you debit to bank. You pay 280 only, no problem, retained earnings to bank. But if you pay 320, at 20 rupees will go into why sir PRL? So first of all, why retained earnings? That you tell. To whom are you paying money? Employee. Who is holding a paper? Which paper is that? Equity instrument. It is like buyback of shares. Buyback of shares, you will put it in PRL. On general is over, no? Where will you put? Equity rate has to adjust. That's why equity. Retained earnings will adjust. But if you pay more than that, why are you paying more than that? Tell me, sir. A paper worth 300, you snatched that paper, he is crying. Ideally, how much compensation should do? 300. If I am paying 20 rupees extra, why am I paying that? Think. Because I want him to continue in the company. I don't want him to feel bad. He is my employee. If I am paying the 20 rupees in the capacity of employee, employee compensation, how can you book it to retained earnings? That will go to a 300 I am paying to him in the capacity of equity instrument holder. That will go into retained earnings. Just like compound financial instrument, this fellow split personality. Equity also, outsider also. Employee insider, outsider. Normally employee outsider. But as long as he has paper in his hand, he is equity instrument holder. So that value, debit retained earnings only. Pay anything extra, PR. Are you getting it, sir? So whenever options are cancelled, 3 points are written. Number 1, preponement of option. Remaining period, whatever expenditure is there, book it off right now. As good as options are vested immediately. At option expense, you account it. Next, since options are cancelled, SBP reserve, merge it off into retained earnings, so general reserve, wherever you want, take it off. If you pay cash, cash paid to the employee to the extent of fair value of option, not share, option, because what we snatch from his hand is what? Option. Fair value of option on the cancellation date, up to that level, you can debit to retained earnings or general reserve, any other equity. You pay anything more than that, that is a loss for us, that you will debit it to PR. A good question. So 3 points or 3 points. First, you have to book the expenditure. Ultimately, you will transfer to general reserve and cash paid will be debited via retained earnings. However, if the cash paid to the employee is in excess of fair value of option on the cancellation date, such excess amount is a loss and it will be debited to P&L account. On that question is there. Question is there. Good case that is. Because that is up to your ESOPs.